Hello and welcome to Chapter 4 of Financial Statement Analysis. Chapter 4, we're going to talk about analyzing investing activities. If we look at investing activities, we're going to talk first just a little bit about assets. And you have both short-term and long-term assets. Short-term assets are things that are going to be converted into cash within a year, within the operating cycle of a business, or within 1 year, whichever is longer. By contrast, you have current or non-current or long-term assets, which are resources or claims that have an expected useful life greater than a year. In other words, they're going to have economic benefit longer than a year. So you might think of long-term assets like vehicles, building, equipment, land. Current assets, cash, accounts receivable, merchandise inventory, finished goods inventory, raw materials inventory, work in process, prepaid insurance, prepaid rent, some types of investments. Investments can be in one or the other. So assets. Here's some examples like we just talked about. On the non-current side, fixed assets. That's really just a broad comment based off of long-lived assets that have a useful life greater than a year. And intangible assets are going to be like franchises, and franchise like McDonald's franchise, a Chick-fil-A franchise, a Subway franchise, trademarks, patents. Basically, intangible assets are something that you cannot have and hold. Current assets, cash and cash equivalents, really talk as much about liquidity and how quickly we can convert something into cash. You have current assets, cash equivalents, readily convertible, and highly liquid investments. They're close to the maturity date, and they're going to be investments. And typically, these are classes of investments that are investing that are not held to maturity. Next one are cash and cash equivalents. Companies, sometimes they have those balances, but they are required to have compensating balances based off of some of the covenants that they might have in their loans. They might have to have some of those as collateral based off of something that they have in debt. So even though they have a lot, what you might find out is that they have compensating balances. And you can see this little slide on the bottom here where Dell has a huge cash advances, but based off of the nature of their business, they may end up having to have those carried on their balance sheet, so they might be restricted. Receivables, you have really two broad categories of receivables: accounts receivable and notes receivable. Typically, accounts receivable are going to be things that are another term you might hear is trade receivables, and it's based off of the good faith of the business. They'll look at their financial statements and determine what it is. And the key issue here is they're generally going to be on some type of short-term credit terms, 20, 10, 20, 30, 40, or 60 days for the most part. And some of them will have 210 net 30 or something like that where they'll offer an early pay discount. Notes receivable is completely different. It has actually a promissory note, and you're required to pay interest on notes receivable typically. That's one of the big differences. And most of the stuff you'll see in accounting text is they'll convert accounts receivable to note receivable and a business can't pay. How you value it? You put them on the books at a net realizable value using an account called allowance for uncollectible accounts. In some texts, they might call it allowance for bad debts. It's a contra asset account, and they use that to keep track of what it is. Now, the one thing that's interesting here in the bottom, it talks about what they estimate. So here's one of the places in the financial statements where it's an estimate about what their percentage of uncollectible is. And you probably, when you look at the financial statements in an annual report, it's going to say uncollectible net. If you just look at if you look at it, it'll say net receivable. But in fact, if you dig back into the notes, they'll tell you exactly what approach they followed to calculate their allowance for uncollectible accounts. So what are we looking at for receivables? You want to look at collection risk and authenticity risk. Authenticity of receivables. Collection risk says, are they going to collect what they need? And what is the receivables as a percentage of sales relative to other companies in the same industry? You use other companies in the same industry because those companies typically are going to have very similar credit terms to the company that you are analyzing. And you want to look also to see if they have them all in like maybe one or two customers. And then the risk may be that those customers might be at the risk of failing. So that's another place you might validate that. For example, maybe you have right now a company might have a lot of receivables with Sears and Kmart. Well, do you think that those customers or those receivables might be at risk? I think they might, based off of the current environmental and operating conditions for Kmart and Sears, where they're closing all the Kmart stores. You have to look at that relative to your company and your industry to make certain it makes sense, and also compare it to others. And the authenticity, you want to look at return policies, contingencies, and receivables. Why is that important? Because some companies might have receivables, but it's really not pure receivables. It might be consigned inventory sitting on the floor somewhere. But that's one of the things you want to look at for receivables. Now, securitization of receivables, sometimes called factoring, is when the company sells a portion of the receivables to a third party. What's a good example of this? If any of you have ever bought furniture at, say, not a Haverty's, but maybe a local furniture store, well, what they'll do is they will give you a credit application if you want to buy it on credit. And once you buy that furniture, pretty soon that the receivable that they have will be sold off to a third party, and somebody else will be collecting the money from that loan or from that credit that they extended to you. Because what they're trying to do is they're trying to get more money so they can buy more furniture to make money. So, but the big thing here is if they have to sell it with recourse, without recourse. If they sell it with recourse, basically what that says is they can transfer, whoever they sold it to can transfer the risk of that ownership back to, say, the furniture company in my particular example. If they buy it without recourse, then all of a sudden it can't go back on the company that sold it. And typically what they're going to do is they're going to give back a portion. They're going to reduce the value of the receivables by a certain amount for somebody to buy it. Like maybe they sell $100,000 worth of receivables, but they'll discount it at 3%. So they'll maybe we'll sell it to the factor or the company that's buying them at $97,000. Prepaid expenses is another one. And the one we've typically seen in most cases is prepaid rent or prepaid liabilities. But these are just classified as current when their magnitude is large, and a couple things you want to take a look at. Any substantial changes in prepaid expenses you have to really look at, and what are their magnitude. A lot of them ends up being like prepaid taxes, some of those kind of things. Different types of inventories. You have inventories that are held for sale or goods acquired in the process of being ready for sale as part of the company's normal operation. So what you're really talking about here, which this is not laid out well, is you're talking about merchandise inventory for, say, a retailer that buys stuff that's already ready to go and they're just going to turn around and resell it. You have raw materials, which essentially would be, if you're a candy maker, it might be milk, cocoa, the wrappers, the boxes that you're going to ship them in, the bags, that's all raw materials. And then finished goods would be the product, maybe in a big box that's going to ship off to the merchandiser to sell. And these costs are inventoriable as they produce the product. And when you expense inventory cost, that's going to be this next one, that they're reported as period cost. And capitalizing means that we put product costs as an asset until they're sold. And so we capitalize costs, which we might capitalize if it's a fully absorbed costing company. You're going to capitalize direct labor, direct materials, and some kind of indirect or overhead costs as well for the cost of production at the manufacturing facility or the processing facility. Different types of inventory methods, LIFO, FIFO, and weighted average. You can see how it's worked in each business. LIFO, last in, first out. FIFO, first in, first out. Weighted average takes an average. And another, typically that other might be specific identification. We're going to go through an example, but really what I want you to know here is, in FIFO, it says that the oldest goods are sold first. So picture going to a store, a dairy, in the dairy section of a supermarket, and you get milk. Well, when you get milk, they have a rack that slides the milk forward as you get it. That's the physical flow. And they go to cost of goods sold first. So that's first in, first out. And then the most recent costs are in inventory. And what that would mean, if you think about this for a minute, if prices are rising, The more expensive stuff is remaining in inventory, and the cheaper stuff is going out. That's FIFO. First in, first in. The most recent cost go to cost of goods sold, and the oldest cost remain in inventory. So the cheaper cost, if you're in an era of cost increases, are going to remain in inventory. That's first in, first out. And you want to figure out the average unit cost. You take the cost of goods available for sale, and actually you take cost of goods sold divided by the units available for sales. What they're looking at here is they want to know what's the average cost for the units that they're selling. So now we're talking about average cost. And here's a little example. Now I'm gonna go slow through. I'm not gonna go through these slides completely, but it kind of gives you an idea of what they have. And really, the formula you want to see here is beginning inventory plus purchases, or if they're a production company, plus units produced, gives you goods available for sale. So in this particular case, they had 40 units in the beginning inventory, plus they purchased another 60, so they have 100 total units, and they have $56,000 in inventory. The sales remains the same for each. It says they sold 30 units at $800 per unit, and so their revenue is $24,000. But we're going to look at each inventory method just very quickly. So here's beginning inventory. There's the net purchases, and here's the ending inventory. And they basically backed into this ending inventory to figure out what the cost of goods sold is. So they kind of backed into this number, even though it's not really well presented here. But essentially how they got this number is they said, we're doing first in, first out. So if we go back one slide, it says that they sold 30 units, but they're going to do first in, first out. So they're going to have 30 of these units were sold. So you take 30 times 500, that's $15,000. And the rest, 15,000 less the 56,000, or 56 less 15, excuse me, gets you 41,000. You can follow the math, and you can go back and forth in this presentation to see the rest. But here, they sold 300 units at $60, so it's 18,000. 56 less the 18 gives you 38. And the last one we had an average cost, and I don't remember the average cost, but you're just taking the average cost times 300 units, which must be about $560 or $56, excuse me, and that calculates here. And you can see the difference in gross profit for each. The gross profit for FIFO is the highest because they're selling the cheapest goods out. For LIFO, it's the lowest because they're selling the most expensive goods out. And for average cost, it fits somewhere in the middle. And we can go through a little bit more of this, but you have phantom profits and inventory is the big thing I want you to know. So I would hone in on when you are reading the information on the financial statements, the notes of the financial statements, I would hone in on what inventory method a business is using, if it's FIFO or LIFO. That makes a big deal. LIFO liquidations, it means that LIFO means that if they sell out inventory pools in LIFO, the further you go back, the cheaper the inventory is. And if the cheaper the inventory is, that means that the profits for the business is going to go up if they have LIFO liquidations. So that might be something you want to be attuned to, or if you're in industry and you have a job and you're using LIFO, it might be something that you could use, and I didn't say this, to play with the numbers for your financials. And then you have a restatement. You have to do a restatement for this LIFO reserve. I'm not going to go through the calculations, but you can see these here. And why is that important? Because you want to take a look at this for your financial statement. So if you are using a comparison company that has a different inventory method, you have to go back and restate their inventory consistent so that they're consistent with one another. Because otherwise you have to have an apple and an apple, not an apple and an orange. Okay, long-lived assets or fixed assets. This is stuff where you have tangible fixed assets. Property, plant, and equipment is one of the things you might hear these called, or fixed assets is another term. And then you have intangible assets. We touched on all this already. And then you have these deferred charges for research and development and natural resources. Natural resources are going to be oil and gas, etc. And you notice the key word here is long run. Capitalization, basically what a company says is they're going to determine how they capitalize costs for a particular product, for a particular long-lived asset. And most companies will not publish exactly how they what their capitalization policy is, because they want it to be a little bit on the gray side. But what we do know is they want it to be able to, that it's going to have future benefits, and it's going to be over a longer period of time. And there's some gray in what happens with capitalization and how they allocate those costs depending upon, which is basically an expensing. And I know you guys know most of this, but you're going to depreciate tangible fixed assets, you're going to amortize intangible, and you're going to also have depletion for natural resources. And you can use, there's several different methods. You can use straight line, some of the years digits, double declining balance, or units of activity. Each one is different. A lot of times the depletion might use units of activity based off the number of tons or gallons or barrels or whatever that they take out and their estimate, and you're using also salvage value. What are some of the distortions? You might have some impairment on asset value. Why would you have impairment? Because they're no longer using it, and it distorts the value of long-lived assets. So one of the things you want to look at is there something in the assets that actually is impaired, that it no longer has value, that they close the plant and they haven't written those assets down. That might also give you a window into what's going on with that. So that's a big deal. Plant assets. What are the big things? They're tangible, actively used in operations, provide a future benefit, and sometimes they're called property, plant, and equipment. So what do you have? You have a purchase price, and then all the other expenditures to get that asset ready. So that might be freight, that might be putting it on the floor and attaching it. It might be all sorts of different things, but you notice it doesn't include acquisition cost, does not include financing charges and cash discounts. Those really are a function of financing, not what it costs you to put them into service. And what are the limitations? The limitations here is that the valuation emphasizes historical cost, which is a GAAP principle, and conservatism, and accounting for money invested. So what does that really mean? They don't reflect the current market value in GAAP. Now, if we were using IFRS, they would, but it doesn't reflect the current market value on the balance sheet. So if you looked at land for a company that's been in existence for 100 years and it started in downtown Chicago 100 years ago, the land value in the books is probably going to be at the historical cost of what they paid for that land way back in 1900, let's say, or 1915. That's something that's, so does it really assess their replacement values? It does not. And it doesn't compare across companies. Why? Because if they have different values and different ages of companies and different growth patterns and different acquisition patterns and all sorts of stuff, it distorts their balance sheet. Because if one company buys another company, what they're going to do is they're going to do an appraisal of the assets that they've acquired, and they're going to put their on the books at that value, at the replacement cost or the market value, not the historical cost. So depending upon how a company grew can determine whether or not that the assets are the fixed assets are comparable. So that one I would be really careful of. So a good prime example that might be Kohl's. Kohl's is pretty much a brand new company, or within the last probably 25 years. Whereas if you were to look at JCPenney, they might have the exact same number of stores, but their stores are completely different in what they do because they've been in existence way longer than Kohl's. So you're, in a way, you're kind of comparing apples to oranges when you look at and it's not necessarily plant assets, but fixed assets in that particular case. So we do a depreciation, which is an allocation to expense. And I'm not going to go through a lot of this. This is just basic principles on accounting stuff in the class here, and you should follow this. And here's some more calculations for it. And for each depreciation, the cost, the salvage value or residual value, the useful life, and what depreciation method. You can use accelerated or non-accelerated. And it's going to just show what this one's going to be straight line, and I'm not going to go through the calculations a whole lot. But you could do, and then here's a double declining balance. And you notice the double declining balance, which would be an accelerated, ignores the book value. So you can see the formula here. This is the same formula you see in your books. And then you have depletion. And depletion is basically going to use different categories. But the biggest thing is, what do you have in the remaining life? And you want to look at that to kind of get an idea of how old the assets are. Intangible assets, you have different, no physical substance. They provide exclusive rights or privileges. They're required for operational use. And remember, what we have here are assets that would be like trademark or patents or franchises are just some simple examples of intangible assets. And here we go: patents, copyrights, leasehold improvements, goodwill, and trademarks. The one I want to highlight just for a minute here is goodwill. Goodwill, by definition, is really when you buy another business and you determine whatever your purchase price is, and then you go out and you value all the assets. The difference between what you paid. Let's say you paid $100 million for a business, and you go out and value the assets at $75 million with independent appraisals. The other $25 million that you have in those assets would be considered goodwill. And there's some things that you learn a little bit more about goodwill impairment, and that might be for another class. But ultimately, there's impairment tests. But if you were to look at it, goodwill would be impaired. Let's say you bought a brand that you did away with. Maybe you're a company that wants to buy a brand and no longer use it, but you need it to have it as part of your company so it'll help your competitive situation. Well, they'll do an impairment test on that goodwill based off certain sets of rules, and you will be required to write down or write off a portion of that. They used to amortize it; they no longer do that. And so you want to look at these often. So you want to look at the goodwill in the balance sheet and see if there's earnings from goodwill, and if there's amortization. And you notice it talks specifically about goodwill and what there is and what has changed with goodwill. So that's it. See here, this is one I was just talking about. Recognize goodwill has limited useful life, and you have to be certain that if it's supposed to be on there or not. Now, you might not be able to make a determination, but you can definitely make notes and make comments about what you saw in the financial statements relative to that. Well, that's the end of chapter 4. I appreciate your time, and I will see you in chapter 5. Have a good